Hello, everyone, and thank you for joining me today. We're going to be talking a little bit more about seg funds. This has been a webinar a few advisors have requested over the last number of months, and I've had lots of discussions with advisors about building out their seg fund business. Actually, I did change my settings, so I should just check one thing. Okay, yeah, we're set up right. This presentation, I'm going to go through a few topics. We're going to start with a bit of an overview. This is sort of the first webinar in a longer discussion of how this fits into your practice and how kind of each of these items kind of fit with your client base. Everybody's a bit different. You're going to have to build some of your own sales processes and service processes, but I'm going to start a little bit at the beginning and go through some examples as we go through some of the different things you should know about seg funds. I'm going to start with kind of a general overview. Seg funds, they are uh, basically they're mutual funds that have additional guarantees, insurance and life insurance related guarantees that allow them to be sold through insurance advisors. Um, they all have a death benefit. Well, most have a maturity benefit, but it's not always that popular. And you can get different sorts of guaranteed options. So most common being the 100-100, which is 100% maturity benefit and 100% death benefit. So however much you invested, that amount is guaranteed, essentially. And then you can reset the maturity value as you go. The 75-100, it's the death benefits that is the 100 and the 75-75, which is by far the most popular, 75-75. So it's a fund. There's a wide selection, hundreds of funds available, thousands if you look at all the different carriers, lots of options for each of your clients. And with the 75-75, it is similar in cost to a mutual fund. So it's competitive, but we get a few extra advantages by buying seg funds relative to mutual funds or ETFs or other products in the marketplace. For one, if the client is a bit older, closer to their estate, bypassing probate can be a big opportunity with the client, especially with larger estates. Creditor protection is another one. This could play into the corporate market if you have corporate clients, as well as personal business owners, self-employed, that sort of thing that want that additional creditor protection in their investment portfolio. Never know if somebody's going to get sued or if somebody's going to run into some financial trouble. And it's also very quick payouts for the estate. So again, the estate planning opportunity with seg funds is great. Um, but I'm going to go through use cases with all the different types. The 100-100 is a little bit more geared towards very conservative investor. You do pay a higher fee for getting the maturity guarantee and getting for the 100% death benefit guarantee. It does allow you to kind of lock in your gains. So if somebody was maybe like a GIC investor or a very conservative investor, they don't want to necessarily take on the volatility of investing in the markets, but they want to have the opportunity to participate in the upside. This can be a really great option. It's also great for estate planning. Think of some older clients that they don't really want to take on a lot of risk. Maybe this is part of the money that's going to the next generation. Maybe they sold a business, sold a farm. And if they're really focused on not losing, essentially, this is a seg fund offering that allows you to guarantee the principal that you've invested. Some clients, wherever they are in their retirement or estate planning needs or goals, this could be a very powerful option if they're focused on protecting the principal, because this is 100% protected on both sides. Uh, the next one would be more geared towards estate planning. So they're less focused on sort of the day-to-day volatility and more focused on the estate. When I pass away, I have X amount, say 500 grand in my portfolio. Now I don't want to lose I don't want it to be any less than that. I want it to be at least 500 grand going to the next generation. And they divide it up, say, between their three kids or two kids or whatever. So if this is an estate planning tool, you're guaranteeing at least a minimum estate value on your seg funds. If the market collapses or has a correction rate as the client passes away, the death benefit will kick in and 100% of what they invested was put in will be paid out, which again, very powerful planning tool. For certain clients, it's a really good fit. Not everybody is sort of interested in paying an additional fee because there is a cost to have the 100% death benefit. But for those that want it, this is a very powerful tool and not something they can get anywhere else. So you can't get guarantees on your investments, especially like any market investments in stocks, bonds. If you're in an ETF or at the bank and mutual funds, or even with an IROC broker in individual stock, they can't guarantee you what it's going to be worth at your estate. We have the opportunity to do that, and that's a powerful tool to have, and very makes us very competitive in the marketplace. Now, by far the most popular option is the 75/75. So, why do our investors use this, our advisors use this so often? It's because it's the most cost-effective mutual or seg fund, really. You're not paying for any additional guarantees, but you get all the other benefits of seg funds. You still get the credit protection. You still get you still bypass probate. You still have a much faster and more efficient process for your estate or your beneficiaries inheriting the money, especially in a non-registered portfolio. Um, the estate is just a lot more efficient with using seg funds. So those are sort of the benefits, and it's at a very small additional cost. So we've seen this work for quite a few clients. We actually had our biggest seg fund client ever come in this year, a $6 million client, and they were really focused on actually the privacy around their estate. So bypassing probate is one of the benefits, so that can be a cost savings. Kind of ranges from 1.5% to 2% depending on what province you're in, what your probate costs will be, and that's on your whole portfolio. So bypassing that can be a big number for a $6 million client. That was substantial. They wanted the ability to name their beneficiaries, and they didn't want everything to be public. So one of the challenges with a will is the will becomes publicly accessible. After you pass away, everybody can kind of find out where the money went and how much there was, essentially, which is a bit of a challenge for somebody who wants to sort of disperse their estate in a way that might not make everybody happy. So they wanted their kids to receive certain amounts of money. They didn't want everybody to know how much money there was, and they wanted to give some money to charities, and they thought that their children might not necessarily like that they gave a bit of money for charity. Of course, the executors are still going to find out, but the not everybody necessarily would be aware of that. And they had some causes that were very important to them that they wanted to give money to. So they wanted to keep things very private. They wanted things to be handled very quickly. They didn't want it to go through the full probate process. They still had a house and stuff that was going to go through the will and through probate. But the bulk of their investments, this $6 million, they were very focused on this is where I want it to go. This is how I want to divide it up and want it done quick, easy, and no fighting. As many of you know, a lot of families do uh, get into fights or battles over the estate of loved ones. It's a very emotional time, and obviously people are losing their mother, their father, their parents, and they're grieving at the same time. They're starting to work through the estate process, and money can drive a wedge in between family relationships. So it's something that's important for us to help our clients with in building a really airtight estate plan and helping them sort of get through like hopefully get their family through this process without division, without people fighting. And this is a way to make that process a lot more effective and streamline, which makes it a lot less likely that there's going to be fights. And if we do our job correctly, we can make sure everything's done correctly and quickly, and then there's less opportunity for clients and their families to sort of break apart and have a negative outcome. So this is a very powerful tool that we can use, and it's a very minimal increase in cost relative to the competitors. What I'm going to go through here, the mutual funds are sort of the biggest competitor to seg funds because they are essentially the same fund. So you have often the same managers, the same fund, like the funds are the same fund. It's just an additional series. So they might have an A series, an F series, mutual fund, and then they have seg fund versions of this 75, 75, 75, 100, and 75, and 100, 100. So it's just a different series in many cases this of a same mutual fund. So there's advantages to this. You get high quality managers that have great track records, specialties, like specialize in certain areas. There's a lot of pool capital. So some of these funds are into the billions of dollars collectively, even though the seg fund might be is often a bit smaller than the mutual fund. You get all the same benefits of any other mutual fund or any other seg fund, but you get the access to a very wide shelf of essentially mutual funds through the seg offering with the additional benefits. So the cost difference, if you're doing the 75/75, is often about 10 basis points. Some carriers are a little bit more aggressive on pricing than others, but that's sort of what the ballpark is. And I think that's a very reasonable cost for the additional benefit you get. There's also the other services that is offering. Not all mutual fund advisors do financial planning, not all do estate planning. And if you're competing for a wealth client, you have those tools that you can offer to help get these clients in the door. And seg funds are still competitive as a wealth management strategy. We see a lot of advisors building significant books, 20, 40, $50 million in or higher in seg fund assets. And not everybody needs to go the mutual fund or IROC or CRO route just to get into the wealth management business. If this is something that you want to focus on building your wealth practice, you can do that without any additional licenses. The seg fund offering is very strong. Many advisors haven't seen it as a limiting factor at all in the marketplace. I mean, it really comes down to your service and your offering. And you have so many options available through seg funds. There are literally thousands of funds between all the carriers that you can find the right portfolios that fit for you. And I'm going to go into a little bit of that, some of the investment strategies that are common. So one, there are a lot of advisors that, especially for smaller clients, use portfolio funds. So portfolio fund is essentially a fund of funds. So it's a pre-built portfolio. It has allocations to different geographical locations. So like think Canada, US, international, emerging markets. It has allocations to fixed income. If it's not a full equity portfolio, more aggressive investors obviously would go more full equity. But it has the bond allocation or fixed income allocation. They do regular rebalancing within the fund between the different sectors, geographical allocations, different holdings. And they also do, because it's the fund of funds, the funds actually do their own rebalancing as well, their own investment management. So it is professionally run at the fund level. So in each sort of region or geographical, each fund they have, so the fixed income fund has a fund management structure that's geared towards fixed income. So the portfolio manager is a fixed income expert. They would be the one managing the portfolio with their team. And then same with each of the locations. So if you had an emerging markets like fund, that portfolio managers managing that fund would be managing the day-to-day, picking the individual stocks, analyzing which countries to allocate to and within the emerging market mandate. So you get the fund level expertise, and then you also get the portfolio level expertise, where the portfolio managers at the carriers are selecting which funds and rebalancing within those funds. So it's a one fund solution to the client, but they get a full portfolio with that one fund. It can be very easy to manage, especially for smaller clients. Like this is the portfolio it's in. You're instantly diversified. You can add money very easily. Um, Reasonable fees for smaller clients for sure. Sometimes you actually see clients that are in because their parents are in with a portfolio manager or some IROC advisors where they actually have very high fees because they don't have enough capital and there's a certain amount of account fees on an annual basis, as well as sort of some minimum, like some transaction fees that we don't have with seg funds. Not everybody really appreciates that, but in a lot of like Zero or PM shops, there is a $5 or $10 fee for every trade. Now, that's not a problem if you have $1 million account, but it can be an issue if you have a 10,000 or 50 or $100,000 account and you're doing a lot of trades with a lot of different funds. So I think that's something to be mindful of. Also, $150 like annual like account fee is nothing for a larger client, but for some of the smaller clients just starting out, maybe they bought a house or they're a young professional, they're a doctor just getting out of the residency and starting to make real money and starting to save. They might be saving a lot, but their account balance hasn't really caught up yet. So this can be a very efficient solution to get a diversified portfolio that is well managed at all levels. And from the advisor perspective, it's very low admin to just to have one account with one fund in it. From there, a lot of advisors start adding essentially some additional sort of specialty funds or enhancements to the portfolio, or a couple of sort of common terms for this. So you can use the portfolio funds as a base and then increase exposure to additional opportunities. So uh, real estate might be a common one. There's quite a few of the carriers that offer real estate funds. They are an additional sector that you can allocate to rental income, property growth, value growth. It's an opportunity to add additional diversification to a portfolio. So that's a common one that we see. We also see some that want to focus, especially with some of the younger clients, a little bit more focus on tech. They can accept the volatility. Technology it can be a very volatile sector to invest in, but also has additional opportunity. Can create and has created in the past some very high returns, but there's a lot of volatility. So the client needs to be able to withstand a bit of a drop in their portfolio in order to position their portfolio to have a higher return longer term. So that might be something you kind of build. So the base or the core of your portfolio with a portfolio fund, and then you kind of add to it. So you can add real estate funds, you can add tech funds. You might want to add certain like certain like sectors or geographies. Maybe you want to be a little bit less focused on the US, a little bit more in Europe or emerging markets. So you might just add a specialty fund on top of the portfolio fund, which sort of increases your weighting. You could do that in Canada too. You can also go into specific sector funds if you want hospitality, if you want mining, if you want oil and gas, if you want on the other side socially responsible investing. All those options are available. So you can kind of tailor the offering to the client without sort of going the full custom route, which is a little bit more labor intensive, a lot more fun. So think of having a portfolio fund as the base of a client's account and then adding kind of one to three additional funds that sort of adjust the portfolio a little bit and then yeah, kind of add some enhancements essentially to it. And then we get into building a full custom portfolio. So this is something you typically wouldn't do with a smaller client. So it might be something that you have a higher threshold before you kind of do this additional work. But you essentially are now the one building the full portfolio from scratch. And some clients want this. Sometimes they want to really focus on not investing in certain areas, so they can't use portfolio funds. Like, say they just, for political reasons, they didn't want to invest in the US right now, which yeah, definitely some political angst right now, and some fighting between the Canada and the US right now. So if the client had that strong preference, you could build a custom portfolio that excludes the US. You can buy, there's global funds, ex North America that would invest in Europe and emerging markets. And then Canadian, you could overweight Canadian companies. You can't get to the point where you'd have zero exposure because even a lot of Canadian companies would have some exposure to the US, but you could at least get away from allocating to the US stock market and the companies that are focused there. So that could be one reason. Maybe they want, or maybe they want more exposure to sort of to the tech space. So they might want a bit more exposure to the US, because a lot of tech companies, especially the large tech companies, are out of the US. Or you can just kind of build a custom portfolio with the client, so you can understand where they're allocating. You can be the one managing their allocations. So they might want more in Europe, less in Europe, more in emerging markets, less in emerging markets, whatever. You can build a full custom portfolio. You can have the real estate, you can have the tech, you can not have any of that. This is a full custom portfolio. Typically, I wouldn't want the advisors to get into this until they have done a little bit of sort of coursework and learning about the investment side. I'd say start with portfolio funds, then start adding enhancements, and then building some custom portfolios. It's helpful to have a bit of experience. I'm a chartered investment manager, so I've done some coursework. I also as part of that, I did the CSC years ago, and certified financial planner. All of those sort of have taught me different strategies for managing risk and building portfolios. And I'm pretty confident that I can build custom portfolios for many clients and have. But when you're just starting out, you're welcome to call me and we work through some of these options and talk through how to build it if you have a bigger client that wants a custom portfolio. And and then we can kind of, there's times where you want to sort of adjust their biases, like if they really, for political reasons, want to avoid certain things in their portfolio. But other times, if they just want a full like custom portfolio and they want you to build it, you can call me, we can have a discussion, we can talk through their goals. Some of their biases, maybe you want to sort of push back on a little bit, like, hey, I don't want any exposure to the US. Well, maybe we just have like less exposure, but not zero, because we can't really get to zero. I mean, if we buy all Canadian funds, like TD might be one of the holdings, TD Bank. Well, TD Bank has exposure to the US, so we can't quite get it down to zero. Also, like oil and gas mining, some of the products go down to the US, so there's still exposure even with full Canadian companies. So yeah, when we're building these custom portfolios, we have lots of flexibility. There's lots of different ways to build them, but we still need to create the right diversification. We don't want to be over allocated or over allocating our clients to certain strategies or geographical locations that might go well in good times, but could really take a hammering. And you want to be cognizant of the risk you're taking on the portfolio on the client's behalf. And you have to make sure that you're working within the risk tolerance. So there's risk tolerance questionnaires. There's understanding how aggressive a client wants to be, how much volatility they can handle. Those questionnaires can be a great tool for understanding the client. And not every client wants to sort of swing for the fences and make a high return. Some are a lot more conservative. But you want to kind of tailor the portfolio, whether it's the portfolio fund, the enhancements, or full custom to that client's risk tolerance, because really it's their, some want to take on more risk, some don't. It's their experience that's going to dictate if this is successful, and you don't want to put them in maybe a portfolio that's higher risk, and then they want to cash out, or they do cash out whenever there's a downturn. You need to be able to accept the risk of your portfolio and manage the events properly. So if you are in a full equity portfolio and there is a downturn, correction, the client needs to have the fortitude to either invest more or to stick with it and let it recover. If they get nervous, get scared, cash out, they're locking in their losses. That's a bad outcome for the advisor and for the client. So we just want to, maybe if they don't have that sort of risk tolerance, you just have to dial down their risk in their portfolio, which typically means more fixed income. You can do that in the custom portfolio. You then also need to do your own rebalancing. So maybe every once a year, maybe it's every couple years, or it's event driven, but you do need to adjust. If your equities have done very well in a custom portfolio, you're going to have to sort of trim them and add to your fixed income. Same if there's a bit of a downturn. Equities might have been doing poorly. Maybe you're selling some fixed income, buying some equities again. If it's a custom portfolio, that's on you. If it's you're doing it through the portfolio funds, the 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 fund manager of the portfolio fund is doing that on your behalf. So a little bit less admin. Part of why you only want to work with larger clients for custom portfolios. Don't want to be doing a lot of changes where you're moving, like if you do a rebalance and it's $50. That doesn't really make sense to do that extra paperwork just for a little bit of extra, well, just to rebalance a portfolio. So there is a lot of options available with seg funds. The most popular carrier is definitely Manulife. For seg funds, they have the bulk of the assets that we have at Advisor Strategies. We're well over 200 million at this point and growing fairly rapidly, adding millions every month, which is a good spot to be. And yeah, we have some very successful advisors building their practices with seg funds. This creates a bit of a bit more recurring revenue than advisors typically get from the insurance side of the business, because trailers are much lower on insurance policies than they are on segregated funds. So a great way to create a base of income in your practice, and it's a great way to sort of wrap your arms around the client and gain additional kind of wallet share, but also more clients through this additional offering. And the second most popular would probably be IA. IA is a popular one, but we are seeing some other providers getting more aggressive in the space. Equitable is pretty aggressive on their pricing. They have some of their fees are a bit more competitive than others. RBC is sort of working and building out their technology a bit more. There's a few other carriers that are starting to get a bit more aggressive in the seg fund space, which is good. We want more competition, but those are sort of the biggest two are definitely IA and Manulife. Empire is another one. Some advisors that like using them use only them. Another bigger, they have a big offering, good back office, so can be another popular option to look at for carriers. But you have support when you're looking at these. I can help with portfolio discussions. I can help with sort of understanding the client's goals and how that translates into what sort of portfolios might make sense. The wholesalers can be great for helping you understand the different offerings within a carrier, like within each carrier, and then you can book with multiple carriers with their wholesaling team for the seg fund side, for the wealth side, and get a really good offer, like really good understanding of their product shelf and what they suggest. people use. So whether it's some of the tech funds, whether it's the real estate, some of the other portfolio funds, kind of understanding everybody's offering. And if you do have a fee sensitive client, there are even ETF portfolios that have lower MERs or management expense ratios, so they are more cost effective and can compete with the robo advisors for cost to the client. Assuming if they're at a robo advisor, they were still with an advisor that had kind of like a 1% advisory fee or referral fee attached into that portfolio, then it is very comparable. Seg funds might even be a bit cheaper. But yeah, that's there's a lot of resources. You also have hub resources. There you have an investment specialist that is one of your contacts, one of your support, your support people at Hub. You can talk to them, get their opinion on different offerings, and talk through clients. You can talk to me. Wholesalers are great, and the carriers. But yeah, I'd kind of start with some of the bigger carriers and seg funds, and see if this is a fit for your practice. I'm also open to coaching advisors that are new to adding seg funds into or the wealth management business into their practice. Happy to go like schedule a meeting directly with you to talk through how this can impact your business. Start building your processes. How do you approach it with clients? How do you talk through these different strategies? How do you position yourself a wealth management advisor? Do you start offering financial planning? If you don't offer it now, is that something you might want to expand? That does help kind of gather the wealth and like gather assets as well. Can is part of the service that often comes with wealth management. And not everybody is doing that. Some are more focused on sort of the investment and portfolio construction, what I would describe as living by the sword and dying by the sword, where if their portfolio is doing well, they can attract more clients. If they aren't doing well, they are losing clients. But if you're offering the financial planning and you're kind of tailoring your portfolios to the client needs, you're going to have a lot higher retention rate. I would still say that you want to do a good job on the investment management and have good returns for your clients. But returns aren't going to be the only driver. The service is going to be a much larger component of keeping the clients. And you want to kind of keep them through full cycles. So markets go up, markets go down. You don't want to be losing the clients on every downturn and gaining them back up on other upswings. It's just not an efficient process. You want to sort of keep your clients happy and engaged. And if you have trouble with managing a downturn or managing the clients, I'm happy to kind of loop in, help you with language and how to kind of keep those services going. But there's a lot of opportunity for advisors with this, and we're even seeing some advisors that are like in the Zero, IROC portfolio managers that still use seg funds. That $6 million client that is a client of a portfolio manager. So they do their own portfolio management. They're fiduciary, top of the industry. They have large clients that they're dealing with, but this client was a fit because of the creditor protection, because of the privacy and the estate plan that they did with this client. They were a better fit for seg funds than for the advisor's portfolio management offering. So that's where they put the client. It just was a better fit for them for that client. And there's a lot of clients that can fit in this offering. So I hope I gave you a little bit to think about. I know I didn't dive too deep into some of the offerings right now. That's something that I think we want to do sort of either directly or with each carrier once we've narrowed it down. Um, so we can do some follow-up meetings on that if you feel free to reach out to me. But I want to thank everybody for joining me today. I hope you learned a little bit about seg funds and the positioning of the portfolios. I would encourage you to reach out to me if you want another conversation. We can dive into this. Also, lots of support around. My number's up there, my email, but you should already have that saved, hopefully, in your phones. And then let's continue the conversation. If you're not currently building a wealth book, I think it's a great opportunity for advisors that are registered investment advisors with different dealers or firms. I do think spending a little bit of time to understand in more detail the seg fund options can be a very powerful tool. We see a lot of, or I see a lot of advisors that are registered elsewhere that still build large seg books because it makes more sense in many situations for the clients and some of their other offerings. And I'm happy to help you, like guide you through those processes, understand what some other advisors are doing, what has worked for them, what might work for you, and understanding your sort of your client base, your target market, and your business plan to understand where we can sort of make things a little bit better. So, yeah, feel free to reach out to me. Happy to have continued conversations on this. If there are a certain group of advisors, I was thinking about doing a study group around seg funds, just a small group of advisors that want to talk maybe monthly or quarterly about portfolio building and positioning with their clients. So we'll see if there's some interest in that. But yeah, thank you for joining me today and take care. Oops, sorry. 1 second.